Indranil Sengupta joins in from CLSA India to talk a little bit more about the macro setup. And Indranil, what is the sense that you're getting in light of the fact that there has been a lot of emphasis on growth this time around in the budget? Do you think that the ball is largely now in the Reserve Bank's court and that there will be an increase in the reverse repo rate?
Yeah, we are looking at an increase of 15 basis points in the reverse repo rate to take the corridor back to 1 to 50 basis points, which is the standard thing to do. Over March 23, we are looking at a 100 basis point hike in the reverse repo rate, and by March 2024, 150 basis point hike.
Okay, fair enough. And talking specifically when it comes to inflation, how much of a concern do you think this is going to be? Give us a sense as to how you believe and what steps you believe we can take to mitigate the rising inflationary trends.
So I think that, inflation will peak off somewhere in the middle of the year. It will probably go up now, but, middle of the year, it probably comes off. And if you look at FY22 and FY23, I think inflation will average around 5.5%, which is close to India's threshold inflation growth, maximizing inflation. 4 reasons why I think inflation will peak off. Number one, we are looking at a La Nina, so there should be good rains. Number two, the RBI's actually, contained money supply growth with the CRR hike. Number three, Governor Das's buildup of FX reserves is holding the rupee despite, imminent Fed hikes. And number four, we at CLSA at least believe that, commodity prices are peaking as well.
Off the currency and, talking about what the Reserve Bank can do, the rupee does seem to be protected currently from the flight of capital. Do you think that, there's only a limited amount that the Reserve Bank can do in terms of utilizing forex reserves?
Well, we estimate India's adequate FX reserves to be around 600 billion. And, including forwards, the RBI today has 680 billion. So there's a $80 billion war chest to fight off any speculative attack on the rupee, which is why we think that, and this is something we've said time and again, that the rupee will now outperform other emerging markets. Is there a risk to this? I think if oil were to average 100 sustainably and there were to be risk off, then, good bit of that 80 billion war chest may have to be used. Then we should worry. But whether you can have a scenario of oil going up and global risk off, limiting flows to India is a moot point in my view.
What about the rising oil prices? How do you believe that is going to impact the overall import bill? And what's your sense in terms of the trajectory as well as the timings of the rate hikes this year in light of what we're seeing on the bond yield front as well as the rising crude oil prices?
Yeah, so, like I said, that, the macro risk to the economy comes if oil settles at 100 and there is risk of drying up FII flows. That's when we would worry. Number two, the current account deficit would obviously widen. Every $10 increase in oil prices leads to $11 increase in the current account deficit. So, for example, if oil is 70, you have a current account deficit of 1.8% of GDP. If oil is 100, you get a current account deficit of 2.7%. The sustainable current account, most empirical studies show, is somewhere between 2 to 2.5%. So like I said, that, we are expecting 15 basis points, on Thursday by way of reverse repo rate hike, and 100 basis points by March 2023 and 150 basis points by March 2024.
Just this morning, there was an article by Swaminathan Iyer talking about the challenge of balancing growth, saying that Nirmala Sitharaman is right to gamble on growth, but she should know it's a gamble. Given the fact that the fiscal deficit is pegged slightly higher at about 6.9% this time around, and we're looking at the overall inflation trajectory, as we spoke of, what we're expecting from the US Fed in terms of the rate hikes down the road, how much of a challenge or a gamble do you believe it will be when it comes to growth in the country?
Well, let me say that we are looking at a shallow recovery this year and next year. The headline numbers in themselves look high, 9.5% this year, maybe close to 8% next year. But, that is essentially coming from a few base effects of a few quarters. Coming to the funding of the fisc, we think that there is an excess GSEC supply of around 5.5 trillion rupees, which is, over 2% of GDP. Now, this the RBI will have to buy by way of OMO at a time when you already have $80 to $100 billion of surplus liquidity sloshing around in the money market. Therefore, we think that, when you tie up everything together, the fact that, interest rates are going up, the fact that there is a large part of the fiscal deficit the RBI will have to fund, we think that bond yields are headed to 7% this March and 7.5% by March 2023.
Right. Thanks very much, Indranil, for sharing with us the outlook on what we're expecting from the monetary policy as well as managing inflation and the growth projections.